This is the 31st question of marginal costing. Two competing companies, P Limited and Q Limited, produce and sell the same product in same market for the year ended March 1991, and the forecast profit and loss account are as follows. Here you can see sales is 3 lakh of Q is 3 lakh. Both are same sales, and variable cost in P is 2 lakh and in Q is 2,25,000. Fixed cost 50,000 in P Limited, Q Limited 25,000. Okay, and here it is asking you are required to calculate P ratio, BEP, margin of safety of each business, sale value at which each business will earn a profit of rupees 30,000. So it is asking to find the sales profit of rupees 30,000. If the profit is 30,000, what would be the sale? And explain which company is likely to earn greater profit in conditions of heavy demand for the product and low demand for the product. Let's solve this question. This is the solution for 31st question. P Limited and Q Limited, we are finding the profit. Sales, it has given 3 lakh and variable cost. For P Limited it is 2 lakh, for Q Limited it is 2,25,000. If you minus sales minus variable cost, you got contribution as 1 lakh in P Limited. Q Limited you got 75,000. Fixed cost in P Limited is 50,000. If you subtract contribution 1 lakh minus 50,000 fixed cost, you will get profit. Here also you can see contribution is 75,000 minus fixed cost is 25,000. If you subtract 75,000 minus 25, you got profit of rupees 50,000. Both the companies earn profit of rupees 50,000. In the question, it was asked to find the PE ratio, BEP, and margin of safety and desired sales. Here for PE ratio, the formula is contribution divided by sales into 100. Okay, contribution here you can see 1 lakh. Here for Q Limited it is 75. Divided by sales, you got 25% as Q Limited PE ratio. For P Limited, 1 lakh divided by 3 lakh. 1 lakh is your contribution. Divided by 3 lakh, you got P ratio as 33.33% as your P ratio. Next, we have to find PEP in rupee. Fixed cost is 50,000 divided by P ratio 33.33. You got BEP in rupee for P Limited 1,50,000. For Q Limited, fixed cost divided by P ratio, then you will get BEP in rupee. Fixed cost is 25,000 and P ratio is 25%. You got BEP in rupees 1 lakh for Q Limited, P Limited 1,50,000. And for margin of safety, it is asking to fund in both. Total sales minus BEP is the formula. Total sales is 3 lakh, BEP here you got 1,50,000, subtracted you got MO as margin of safety. Here 3 lakh minus 1 lakh, you got margin of safety is 2 lakh for Q Limited. Next we have to find desired sales. It is asking to find the desired profit, and sales amount it has given 30,000. Fixed cost is 50,000. 50,000 plus 30,000, 80,000 divided by P ratio 33.33. So we got desired sales as 2,40,000 for P. For Q, here you can see fixed cost is 25,000, profit is 30,000, and P ratio for Q was 25%. Sorry, it is 25% as PE ratio. If you added 25,000 plus 30,000 divided by 25%, you will get 2,20,000 as desired sales for Q Limited. Okay, here in case of heavy demand, PE ratio should consider P Limited is preferred. In case of lower demand, we should consider fixed cost is lower, must be seen. Q Limited can earn more profit because P Limited fixed cost is 50,000 while Q Limited fixed cost is 25,000. Guys, if you like the video, click on like, share with minimum 2 guys and subscribe. It is